Hey guys, welcome back to the channel, and today we're going to be reacting to
Why US bond yields are surging again.
Was brought to you by Brilliant. A couple of days ago, Republicans in the House of Representatives passed Trump's One Big Beautiful Bill, a 1,000+ page mega bill
like the name
crammed
of
with
this
essentially
bill.
all of Trump's campaign pledges. Trump was unsurprisingly jubilant, claiming on Truth Social that the bill was, quote, arguably the most significant piece of legislation that will ever be signed in the history of our country. But the bond markets were less impressed, with the yield on long-dated US government debt rising to its highest level since 2007, only a couple of days after Moody's, one of the big ratings agencies, downgraded America's credit status. So in this video, we're going to take a look at the recent rise in long-term Treasury yields, what's driving it, and what it means for the US more widely. Who's the best? Find it on the TLDR podcast. Kits actually work. In short, when a government borrows money, they do it by issuing bonds. Bonds are essentially defined by three things: the face value, that is how much the bond costs in the first place; the coupon, that is the annual interest rate that whoever owns the bond receives; and the maturity, that is the date when the issuer repays the bondholder the face value of the bond. To give an example, the US Treasury might issue a bond with a face value of $1,000, a coupon of 5%, and a maturity of 10 years. If you bought that bond from the Treasury, you would basically lend the US $1,000. The Treasury would pay you $50 a year for the next 10 years, and after that 10 years, they'd return the whole $1,000. Importantly, however, the effective annual interest rate, or yield of a bond, can change if the markets decide that they don't want to pay the face value. So, for instance, if I tried to resell a bond that I just bought, but the market's willing to only pay a face value of $900, whoever bought that bond would effectively be paid a higher yield. After all, $50 is more than 5% of $900. It's more like 5.5%. And after 10 years, this new bondholder would also get an extra $100, because the Treasury would pay back the full $1,000 face value. But this new bondholder only bought the bond for $900. This means that the effective yield would actually be over 6%. Now, this would be bad news for the Treasury, because it would imply that the US would now have to offer bonds with coupons over 6% in order to attract new buyers. And this is essentially how governments decide what coupon they offer on new bonds. They look at the effective yields of already issued bonds and then offer effectively the same rate. Anyway, in normal times, bonds with longer maturities offer higher yields, because the longer you have to wait to be repaid the face value, the greater chance there is that something will go wrong. For instance, if the US Treasury offers me a bond with a 1-year maturity, I can usually be pretty sure that they're going to pay me back. But if they offer me a bond with a 30-year maturity, which is basically the longest dated bond the US Treasury issues,
It doesn't mean you're not seeing the money, but you have not. Yeah, it's not that you're not seeing the money. It's just like there's no way you know what's gonna happen in 30 years. You know,
it's a bit hard.
like you can somewhat predict in a year. Like a war is not gonna start out of nowhere in a nuclear war in a year. You know. In 30 years, who the fuck knows?
Harder to say, because who knows what's going to happen in 30 years' time. This is why the yield on a 30-year Treasury is usually higher than that of a 20-year Treasury, which is usually higher than that of a 10-year Treasury, etc., etc. To see this, analysts often look at a graph comparing yields on the y-axis and maturities on the x, known as the yield curve. And because longer-dated bonds generally have higher yields, the yield curve usually tends upwards. However, for much of the past couple of years, this hasn't really been the case. A year ago, for instance, bonds with 5, 7, 10, and 30-year maturities all had pretty much the same yield. And for much of the past couple of years, short-dated treasuries actually had higher yields than longer-dated treasuries. In other words, the yield curve has been inverted. However, in recent weeks, this has all changed, thanks to a super sharp spike in yields on long-term treasuries. Early this week, for instance, the yield on 30-year treasuries rose to over 5.1%, the highest level since 2007. And while the move in 10-year treasuries hasn't been quite as dramatic, they're still currently trading at about 4.5%, up from 4% earlier this year, and well above the 3% or so they averaged during 2010s. Interestingly, short-dated bonds like the 7, 5, and 3-year treasuries haven't moved anywhere near as much. So what does this all mean? Well, as with anything in the markets, no one knows for sure.
That's what I'm wondering, because we did all this background, which is cool, but can we get to the point?
But at least some of it seems to be a revision to the mean. After all, longer-dated bonds should have higher yields than shorter-dated bonds, and it was weird that they didn't in 2023 and 2024. So this was always going to sort itself out eventually, and especially once interest rates stabilized. Nonetheless, while it is true that the yield curve was always going to de-invert at some point, it's now gone pretty far the other way, due to the fact that yields on longer-dated treasuries are now at historic highs. So what's this about? Well, some of this is a reaction to a weak auction earlier this month, when the Treasury tried to issue more 20-year bonds, only to find out that, well, no one really wanted to buy them. And this
Oh, we saw that in the video. And there you go. Okay, that's what I wanted to find out.
has made investors anxious about the demand for long-dated treasuries and the liquidity in the long-dated treasury market. because no one wants to be stuck holding bonds that they can't sell. But the main reason for the rise in long-term treasury yields is America's fiscal position. In short, the markets just don't trust that America is ever going to get its ever-increasing debt under control. This is why the 30-year yield spiked over the past week, as it became increasingly apparent that the Republican majority in the House of Representatives would pass Trump's One Big Beautiful Bill unamended, despite the fact that it currently involves a slew of unfunded tax cuts that the Nonpartisan Committee for Responsible Federal Budget estimates would add at least $3 trillion to the deficit over the next 10 years, as well as over $5 trillion more if the temporary provisions, like the no tax on tips and overtime, are extended, which seems pretty likely. In practice.
But that's not a bad idea. No tax on tips and overtime. That would help people do that.
I heard him talking about this, but nothing has been done for
Well, in this bill, decided in this bill.
Oh.
That's not a bad thing.
This means that the US will continue to run deficits of around 6 or 7%.
Like, we shouldn't be taxing tip workers and overtime, people that work overtime anyway. The rich should be paying that tax, not if you have to work overtime, you need the money.
Of GDP for the next few years. And America's debt pile will probably rise from about 123% today to around 150% in 10 years' time. The rise in long-dated treasury yields is basically the market saying, sure, the US probably won't go bankrupt in the next couple of years, and the economy currently looks all right, but we're not too confident about the longer term. And well, you can sort of see where they're coming from, given the fact that both the Republicans and Democrats lack the political confidence to even talk about serious spending cuts or tax rises, despite the ever-widening deficit and deteriorating fiscal position. Doge was supposed to square this circle, but it failed to even make a dent in federal expenditure, and Musk has apparently given up on it. So it's now hard to see how America ever gets its debt problem under control, especially given its increasingly dysfunctional politics.
Musk is bad at
This has
X
made
or whatever
investors
he's at.
understandably anxious.
But that's true though. We haven't heard of him in a minute.
If you're engaged with
And the focus hasn't been on him
Yeah.
either.
And just kind of, I don't know why they made this video. They didn't say nothing in this video, but like they spent like 30 seconds providing new information,
Yeah.
and basically everything else was just a recap. This was not a necessary video to make. I
Can
feel
I
like,
see the comments?
yeah, this is one of their weaker videos. You know what is crazy? Is I'm not sure if he even realizes how bad this is. He's trying to bully countries into trade negotiations while those same countries have the leverage and incentive of walking away from the US bond market. Yes, it's flirting with a serious crisis, and I fear a lot of people will not realize how bad it is until it goes boom. Doge cut all the relatively inexpensive stuff that promoted American soft power abroad, therefore worsening the position of the US internationally, while leaving the most expensive stuff untouched, making no dent in the federal budget. Truly a lose-lose situation of historic proportions.
Well, I think sometimes people have to see and feel, the costs
Yeah.
to understand the lessons,
Mm-hmm.
Guys, of course, let us know your thoughts. Don't forget to like, comment, and subscribe. Join the Discord. Soys. Share as much kindness as possible.